7 mistakes. We've got 7, and I have personally made at least 4 of them.
Welcome to episode 31 of the Joinprop podcast. I'm Ken, head of content here at Joinprop, and basically my background is mostly in the content side of the prop trading space. So I'm looking at the data, the platforms, really the sheer amount of ways people just manage to lose their money. And I guess I will hand it over to you to introduce yourself before we get into the absolute carnage today.
Yeah. Hi, I'm Jessica. I'm a freelance podcaster and I guess sort of your resident skeptic for these deep dives.
Yeah.
I'm completely not a trader, like at all. I look at financial charts and I literally just see modern art. But I'm financially curious and I'm basically here to ask the questions that I know everyone listening to you right now is probably too embarrassed to ask. Because nobody wants to sound like they don't know what they're doing. Which is funny because, I mean, based on the data we are looking at today, nobody actually knows what they are doing, like at all. So, okay, wait, let me back up. Today, we are looking at the incredibly costly mistakes people make when they attempt prop firm challenges. I want to start with a number, just a statistic that it's honestly heavy. The failure rate for people attempting their first prop challenge is 90 to 95%.
90%. 90? I need a second. That is, I mean, you're telling me that out of 100 people who sit down, put their hard-earned money in, and try to get funded, like 95 of them just instantly fail.
Yes. On the very first attempt, 90 to 95, just poof, gone.
Honestly, how does an industry even exist with a failure rate that high? Like, if a driving school failed 95% of its students on the first test, you'd investigate the school.
Well, and that is exactly what I thought when I first saw this stuff. But here's the thing, and this is kind of the whole thesis of what we were unpacking today. It is not because these people, the people listening to this right now who might have failed one, are inherently terrible at trading. Or, well, some of them are. But the data shows that 80 to 95% of these failures are entirely preventable mistakes.
Preventable.
Yeah, totally preventable. It's not a lack of skill. It's not that the market suddenly, inverted on them and did something crazy. They are just tripping over their own shoelaces before they even get to the starting line.
So they're not losing because they don't understand the charts or whatever. They're losing because of, administrative errors.
Basically, yeah. Administrative, psychological, structural. It is this whole messy web of things. And honestly, they're not even sequential steps. You can just cleanly check off a list. They just they bleed into each other. But the trap that gets everyone right out of the gate is just price. The lure of the cheap entry.
Okay, meaning they just pick the cheapest option, which honestly sounds totally logical to me. If I'm trying something new and I literally have a 95% chance of failing, I want to spend as little money as humanly possible.
Right, which makes perfect sense in any other normal industry. You see a budget challenge for $49, maybe $79, and then you see a premium one for $250, maybe $400. Obviously, you're going to click the $50 one. But the source material breaks down the total cost analysis, and it's wild. Because that cheap challenge, by the time people actually pass, the total cost for that budget tier ends up being somewhere between $500 and $1,000.
Wait, how? If it costs $50, how are they spending $1,000?
Because of the hidden parameters. It's the stricter rules, the reset fees, which, by the way, if you fail a rule, you have to pay a fee to reset the account and try again. And cheap challenges often feature these ridiculously high profit targets. So you fail, you reset. You fail, you reset. You're just bleeding out $50 at a time. Whereas the premium ones, the $250 ones, they have more lenient rules, so people actually pass them. And their total cost is just that flat $250.
So it's the classic being poor is expensive thing, like buying cheap boots that wear out every 3 months instead of just buying one good pair.
It's exactly that. But it's also that people they don't read what they're actually buying, which is where that administrative failure comes in. 43% of first-time failures stem from just flat-out misunderstanding the rules.
You're kidding. Almost half of the people failing just didn't read the terms and conditions.
Well, it's a little more complicated than just checking a box at the bottom that says, I agree. The rules in this space they are a lot. We're talking lot size restrictions, news trading prohibitions, you literally cannot have an open trade within a certain window of a major economic news release. Weekend holding restrictions.
Okay, wait, slow down. News trading prohibitions. If I'm trading, aren't I supposed to be watching the news? Isn't that the whole point?
You'd think so, right? But in the prop world, if a major report drops, say the U.S. jobs report, non-farm payrolls, the market goes completely schizophrenic. Liquidity dries up, spreads widen, and price just teleports.
Teleports.
Yeah, like it jumps from one price to another without trading anything in between. If you have trade open during that, the firm's broker might not be able to fill your stop-loss order at the price you wanted. You get what's called slippage. And suddenly, a trade you thought was risking $50 loses 500.
Oh, wow. So the firm just says, absolutely not. Don't even try it.
Right. They say if you hold a trade 2 minutes before or after this news drops, you failed the challenge. And people listening right now have probably done this. They just forget to check the economic calendar for the day. They're up $500 on a Thursday. The inflation data drops at 8:30 a.m. And boom, they check their dashboard and their account is breached. Then, over.
Because they didn't read the fine print on a $50 challenge.
Yeah. And then there's the big one, the one that honestly makes people furious. Consistency requirements.
Consistency requirements. What does that even mean in this context?
It means, okay, let's say your profit target for the challenge is 10 grand.
Mhm.
If you make one really lucky trade and make 9 grand on Tuesday and then make $1,000 the rest of the month, you fail.
Wait, even if I hit the target?
Yeah, because they'll have a rule saying no single trade can account for more than, say, 30% of your total profit.
That feels like a scam.
It's not a scam.
I'm not saying illegal, I'm saying it feels like one. You literally hit the goal they set for you, but they fail you because you did it too fast. That's ridiculous.
Okay, I hear you, but look at it from the firm's perspective. They are trying to find traders to eventually give real money to, right? If you just YOLO a massive trade on a Tuesday because Elon Musk tweeted something weird and you get lucky, that doesn't make you a good trader. It makes you a gambler. The firm wants to see that you have a reproducible edge. The consistency rule is risk management for the institution.
Okay, but if I'm a beginner and I see a $50 price tag, I'm not thinking about institutional risk management. I'm thinking, oh, I just need to make $1,000 to pass. And they put these tripwires in the fine print, knowing that a beginner isn't going to understand what a 30% consistency rule is. It's a structural trap.
I don't disagree that it functions like a trap for people who don't read. But the rules are there. They are published right on the website. And this is why 43% fail. Because they just blast past the FAQ page and start clicking buttons.
But if the rules are that strict and the profit targets are so high on the cheap ones, you're basically forcing people to trade like maniacs.
What do you mean?
Well, if you're telling me I have to hit a high profit target, but I can't do it in one big trade, and I can't hold over the weekend, and I can't trade during news, you're basically forcing me to make a million tiny trades just to inch my way to the finish line before the time runs out.
And that is exactly what happens. You just hit the nail on the head. People become action junkies. They overtrade. And the stats on this are honestly terrifying. Accounts that make 10 or more trades daily have a 60% higher loss rate. 60%.
10 trades a day doesn't sound like that much if you're sitting there for 8 hours straight.
It is an insane amount of volume for a retail trader. Because every single time you enter the market, you are exposing yourself to market noise. You're paying transaction costs, spreads, commissions, and more importantly, you are diluting your edge.
Diluting it how?
Well, unless you are a highly specialized algorithmic bot, you do not have 10 high-probability setups in a single day. You just don't. You might have one, maybe two real clear signals from whatever strategy you use. So those other 8 trades, that's just you guessing.
So why do they do it? Is it just panic?
Panic, boredom, pressure, mostly pressure. They see the time ticking down on their challenge. Though, some are unlimited time now, but the internal pressure is still totally there, and they feel like if they aren't actively in a trade, they aren't working.
Right, because we're wired to think effort equals reward. If I'm staring at a screen for 6 hours and I haven't clicked buy, I feel like I'm wasting my day.
Well, wait, no, it's actually worse than that, because they start hallucinating setups.
Hallucinating?
Yeah, they want to be in the market so bad that a chart that looks like absolute garbage suddenly starts looking like a perfectly good reason to risk money. And all they're doing is churning their account into dust, which actually brings up the absolute worst thing you can do to your account, neglecting risk management.
The math of ruin.
The math of ruin.
Yeah.
The source drops this stat that risking 1 to 2% per trade is not a guideline. It's not a polite suggestion. It is a critical safeguard. If you risk more than 2% per trade, you have a 90% chance of blowing the account entirely. 90%.
So if I have 100 grand in paper money for the challenge, I shouldn't risk more than 2 grand on a single idea.
Less, honestly. 1% is way better because people who keep their risk under 2% have a 40% higher success rate. 40% just from tweaking that one single variable, because poor risk management accounts for 45% of all prop firm challenge failures.
Let me do the math. How are 45% failing from poor risk management and 43% are failing from misunderstanding rules? Are these the same people?
There is huge overlap. It's like a Venn diagram of destruction, because the rule they usually break is a risk management rule, like the drawdown limit. And this is where I honestly have to confess, I have blown an account on this exact thing. This is my ghost of Christmas past right here.
Okay, do tell. What happened?
I completely miscalculated my position sizing relative to a trailing drawdown.
Oh, boy.
So like a trailing drawdown, right? It tracks your highest watermark, your highest equity peak, and then it trails by a fixed percentage or a fixed dollar amount. But the thing is, if it's intraday, it calculates unrealized profits. So if you spike up in a trade but don't close it, the high watermark moves up, and then when the trade comes back down to your entry, you actually hit your trailing drawdown limit, even though your account balance hasn't actually lost any initial capital.
Okay, hold on. Stop. English.
What?
What is a drawdown limit, like, for a normal person? Because my eyes just totally glazed over.
Sorry. Yeah. The jargon gets me sometimes.
Yeah.
Okay, imagine you have a really strict boss. Or no, better imagine you have a corporate credit card.
Okay. I like spending company money. I'm with you.
Right. So the company gives you a $100,000 credit limit. But they tell you, if your balance ever drops $5,000 below your starting point, we take the card away. That's a static drawdown. If you lose $5,000, you're out.
Makes sense. Pretty straightforward.
But a trailing drawdown is like a boss who is constantly watching over your shoulder. Let's say you make $2,000 profit on a deal. The boss says, great, now your limit has moved up. If you ever drop $5,000 from this new highest point, you're fired.
Oh, that's incredibly stressful. So if I make money, my buffer doesn't actually increase. The floor just rises with me.
The floor rises right up with you. So if you are risking 3% of your account on a trade and the market just wiggles a little bit against you before going your way, you hit that invisible floor, boom, account closed, challenge failed. And that is why risking over 2% is just financial suicide in these challenges. You need room for the market to breathe.
Okay, but if someone is going into this, why don't they just test their strategy first? Like, don't play with the strict boss's money until you know you're not going to hit the floor.
Because they suffer from the illusion of skill. People think that because they watch 3 YouTube videos on moving averages, they suddenly have an edge. The source material is brutal about this. It lays out what a proven edge actually requires.
I'm bracing myself. What's the number?
You need a minimum of 100 to 200 trades back-tested. Minimum. And ideally, 200 to 500 plus trades for robust validation.
500 trades, just in practice.
Just in a spreadsheet. Going back in time on a chart, like literally opening up TradingView, scrolling back to 2021 and manually logging. If I bought here and sold here based on my specific rules, what happens? 500 times. And you need to demonstrate a profit factor of ideally greater than 1.3.
And a profit factor is?
Basically, your gross profit divided by your gross loss. So for every dollar you lose, you're making $1.30. It proves that over a massive sample size, your strategy actually makes money.
That sounds incredibly tedious.
It is. It is mind-numbing work. But wait. Doesn't even stop there. After you do all that back testing, you need 30 days of consistent demo performance like forward testing in real time with fake money before you even attempt a funded challenge.
See, okay, I have a question here. Because you just said earlier that 95% of people fail. But let's say someone actually does this. Let's say a listener is sitting at their laptop, they grind out 500 back-tested trades, their profit factor is 1.4, they did the 30 days on demo perfectly, they have a system. If someone actually has a system that works for 500 trades, why do they still fail the challenge? Because I'm assuming some of the failures are these prepared people, right?
They are. And this is the absolute psychological wall. Underestimating the pressure. The saying goes, and the source really highlights this, trading is 80% mental, 20% mechanics.
I kind of hate when people say that about things like, golf is 90% mental. No, you literally have to hit the ball with the stick.
Sure. But if you know how to hit the ball with a stick perfectly in your backyard, but the moment you step onto a course with a massive crowd watching and money on the line, your arms lock up and you forget how to swing. That's the mental game. In Forex trading, 70 to 80% of traders lose money specifically because of emotional decision-making.
The valuation anxiety.
Yes.
Yeah.
Because, well, think about it. You go from trading like fake monopoly money on a demo where there's zero consequences to bam, suddenly you paid a fee, the clock is ticking, and you are staring at a dashboard that is literally passing judgment on you. People completely melt down. They abandon their back-tested plans. They start revenge trading, which is when you lose a trade and immediately open a bigger one to win the money back.
So basically tilting, like in poker.
Tilting. It's identical. And I told you I made 4 of these mistakes. This was another one.
Oh, here we go.
I remember my first real evaluation. I had a plan. I knew my edge. I took my first trade on a Tuesday morning, and I got stopped out. Normal loss, part of the system.
Yeah.
But the dashboard updated and showed my equity drop. And the red number, just seeing that red negative number glaring at
Or
me.
triggered something.
Something in my lizard brain just snapped. I started sweating. I was like, no, I am not ending day 1 in the red. I have to fix this right now. So I doubled my position size, completely violating risk management, and jumped right back into the same market, totally ignoring my 500 trade back-tested setup.
Oh, no.
And I lost that one too. And suddenly my perfectly back-tested system was out the window, and I was just gambling to survive. I failed the entire challenge by Thursday.
Because you couldn't handle the feeling of being down?
Because I couldn't handle the feeling of being judged by the dashboard. The mechanics were fine. My mental game was garbage. And if you don't prepare for that specific feeling, the pressure, the way your heart actually races when the chart drops, the market will just eat you alive.
Okay, so this all brings up something that's been kind of bugging me since we started this whole thing. We have all these people failing. They're paying entry fees. They're paying reset fees. They're breaking rules they literally didn't read. They're tilting. They're blowing up their accounts. Where does all that money actually go?
Well, it goes to the prop firms, which brings us to the ultimate funnel. Not using comparison data and just ignoring the actual industry reality.
Yeah.
And I have to warn you, the statistics here they're grim.
Lay it on me.
The average total cost of failures, meaning the real money a trader spends on failed challenges before they finally pass one, is between $800 and $1,200.
Okay, so people are spending $1,000 just to get in the door.
Right. But here is the massive reveal. According to data from Crypto Fund Trader, 22% of participants eventually reach funded status.
Oh, well, that's not terrible. 22% get the funding.
Wait, only 7% of all participants ever actually receive a payout.
Wait, that's literally their business model?
Well, I wouldn't say it's their entire model. But
No, look at the math. If 93% of people are putting in $800 to $1,200 and never taking a single dime out, the firm isn't making money from trading. They're making money from the entry fees. It's a glorified casino where the game is, can you pass the test? Not, can you trade the market?
Okay, it is not a casino. There is comparison data. People just don't use the data to find transparent firms. There are legitimate firms that connect you to real liquidity and actually want you to succeed.
But the system is entirely engineered to collect challenge fees from the 93% who fail. If I set up a competition, charge $100 to enter, make the rules so incredibly complicated that 93 people disqualify themselves over a weekend holding gap, and then I pay the winners out of the entry fees. That's not a trading firm. That's an arcade game.
You are ignoring the fact that unprepared traders are their own worst enemies here. The firms didn't force them to overtrade. The firms didn't force them to risk 10% on a single position because they were tilting on a Tuesday morning. The firms literally published the rules. If you treat it like an arcade game, that is on you, not the firm.
But the firm knows human psychology. You just said it yourself. 80% is mental. They know that a trailing drawdown limit is going to freak people out and make them revenge trade. They build the environment knowing the failure rate will be massive.
Yes, the failure rate is massive because trading is fundamentally difficult. If it were easy, everyone would be doing it and we'd all be rich. The prop firms are democratizing capital. They are giving someone listening to this right now who maybe only has $50 a chance to trade $100,000. But they have to protect their downside.
Democratizing capital by taxing the unprepared.
Well, yeah, if you want to put it that way, yes. It's a meritocracy. The market is a zero-sum game, you know? Somebody has to lose for somebody to win. And the people who don't backtest 500 trades, who don't read the fine print, who just wing it, they're the ones funding the payouts for the 7% who actually treat it like a profession.
It just feels dirty. It feels like the whole industry is built on the blind confidence of people who don't know any better.
Look, I can't completely defend every firm out there. I won't. There are definitely predatory firms that design rules explicitly to make you fail. which is exactly why auditing the firms and using transparent comparison platforms is literally one of the main takeaways from the source material.
Yeah.
But the responsibility ultimately falls on the individual. You cannot jump into a professional arena without a helmet and then complain that the game is too hard.
Okay, fine. The individual has to put the helmet on. I don't love the structure, but I get that you have to protect yourself.
Right. Whew. Okay, I'm sweating a little bit. That got really intense.
I mean, it's $1,000 of people's money. It should be
Yes,
intense.
you're right.
Yeah.
So let's take a breath. Let's look at the actual real-world path forward here,
Okay.
because it's not all doom and gloom. The source material has a very clear takeaway for people who actually want to be in that 7%.
Put on the helmet.
Put on the helmet. The data shows that traders who actually prepare thoroughly, and by that we mean auditing the firms to avoid the predatory ones, validating their strategies with the 500 back-tested trades, and preparing psychologically for the pressure, those traders pass challenges 2 to 3 times more often than the rest of the pool.
And financially speaking, that's huge. If the average person is spending $800 to $1,200 on failed challenges and you pass 2 to 3 times faster, you're essentially saving yourself, what, $600 to $900 in your first year just by sitting on your hands and doing the spreadsheet work first.
The preparation is literally paying you in saved failure costs. It's the highest return on investment you will make in your entire trading journey, and you haven't even placed a single live trade yet.
So don't buy the cheap boot that breaks. Buy the premium boot once you know how to walk.
Learn how to walk in the fake boots first, then buy the premium boots. Okay, I think we have beaten the shoe analogy to death at this point. But before we wrap up, I want to leave you with one final thought to kind of mull over. We talked about how 80% of trading is mental, right? The evaluation anxiety, the tilt.
Yeah.
So the question you have to ask yourself honestly is, if 80% of this game is mental, are you spending 80% of your prep time on your mindset?
Yeah.
Or are you just sitting there blindly staring at charts, hoping the mechanics will magically save you when the pressure hits?
Oh, that's a really good check. Just a gut check on where your time actually goes.
Thanks. Have my moments. All right, we're going to leave it there for today. In our next episode, we are actually going to dive into the mechanics of what a successful backtest really looks like, so you aren't just fumbling in the dark on TradingView. Thank you guys so much for hanging out with us, dealing with our arguments, and getting into the weeds. We will catch you on the next one.
Bye, everyone. Keep your risk under 2%.